Good morning, ladies and gentlemen. Welcome to the first Petites on Wednesdays for 2025. Really great to have you all back with us. Let's see if this year will be magic, as sung there by Queen. 2024 treated investors well, with mostly all asset classes delivering double-digit returns, except for resources. And some already expensive assets got more expensive, and undervalued markets like South Africa made a really strong comeback. Towards the end of 2024, the beginning of 2025, words like sticky inflation and recession risks resurfaced on the back of rising bond yields. What is the market telling us that we don't know? The Fed advocates for less rate cuts than expected in 2024, and debt to GDP are running hot in most countries. Trump 2.0 comes with threats of renewed trade wars, policy reform, and tax cuts. This could benefit a lot of US assets and certain sectors in the US, but this is causing uncertainty and jitters across the globe. The global markets already factor in what he said he's going to do, and how will things actually change by what he really does at the end of the day? Back home, inflation seems to be under control and the world reacting positively to the GNU, with net positive flows to our bond markets, but not yet our equity market. But SA needs real growth. What do we need to get it right for 2025? Will China be our saving grace this year, or what will happen? Joining us morning to unpack this and a lot more is portfolio manager Matthew Whitelaw from 361 Asset Management. Good morning, Matthew. How are you doing?
Good morning, Eugene. Thanks very much for having me this morning.
Fantastic to have you. It's an absolute privilege to welcome you as our first presenter for the year. I hope you came with a crystal ball, because I think there's a lot of questions from the audience in terms of what to expect for this year. But let's hear from 361. What is your views? Thanks, Matthew.
Perfect. Thanks very much, Eugene, and thanks for everyone on the call this morning for taking the time. Very similar to how we've run this in the past, we'll take you through some of our high-level conviction calls on global macro and just how we're thinking about certain themes within the market at the moment that's kind of framing our positioning for the year ahead. I like to start at commodities, and I think this has been the most asked question over the last couple of years in terms of, is this the bottom in the PGM market and is it time to buy? We're still extremely concerned in terms of the PGM market. There's been two narratives or positive narratives in the PGM market over the last couple of years. The first one's been this destocking cycle, which has been this theme for 2 years. We don't think that it can be a destocking cycle that would last that long. It would last significantly shorter. And then the second positive narrative has been the slowing BEV trend, which we think is a little bit of a red herring. We think the key thematic within the market in terms of PGMs is Chinese ICE vehicle market share. This has gone from around 40% to 65% in the domestic Chinese market, and in the export market, Chinese ICE market shares picked up significantly, whether it's been Mexico, Russia. Just in the local South African market, we've gone from virtually no Chinese vehicles to 10 to 15% of the market, and we don't expect that trend to slow down anytime soon. And the reason that's the big thematic for us is we think Chinese ICE vehicles are using around 50% or up to 50% less PGMs in their vehicles than Western vehicles, which is a significant demand headwind. And then I think when we look at commodity markets on the demand side, we don't really see where the increased demand comes from. Even though BEVs are slowing down, we think that loadings within ICE vehicles across the globe is actually trending downwards. We think it's down up to 50% in China. We think it's down 10 to 15% in Japan. And with Trump coming in, we think it's very unlikely you're going to get increased emissions regulations coming out of the US. So you've likely seen peak loadings there. I think when you look at the palladium market more specifically, over the last year. You've seen ETF holdings rising quite significantly. And then the much spoken about palladium short unwound by over 50% towards the end of last year. And when both these things were happening, you saw a very muted price response. When you have increased ETF holdings and an unwinding short position, you would expect palladium to rise, and you never really saw that, which we think is telltale signs that the palladium market is oversupplied. How does this ultimately resolve? It has to be from the supply side, and we need to see ounces coming off the market, particularly from North America. The risk for us is that there's talk, the highest cost miners in North America, there's talk of rebates. The company's done streaming deals. And if Trump does decide to put tariffs on certain critical metals, all that's going to do is it's going to flatten the cost curve of PGMs further and broaden this bear market for a number of years. So that's just one thing that we are concerned about, and we don't think now's the time to be moving into PGMs yet. I think we're in for quite a protracted bear market. I think maybe moving on and something maybe more positive in the commodity space, particularly from a South African perspective. If you look at Trump's last presidency, oil, excluding obviously the COVID crash, hovered around $40 to $85 over the course of his presidency. I think when oil started to get around $70, you started to see Trump making a number of movements, particularly on OPEC, calling it a cartel. And as oil moved higher all the way to 85, he spoke about, pulling protection from a number of Middle Eastern countries. And he was very firm that he didn't want oil to go higher, and used a number of threats to try and push oil prices down. I think if you look at what Trump wants to do in his second presidency, in terms of enacting tariffs are going to be inherently inflationary, and he needs a deflationary force on the other side. And we think the most obvious one for him to use is try and push oil prices down. I think he's spoken already about increasing US oil production, but I think he's also going to put pressure on OPEC, who has a significant amount of cuts out the market, to protect oil prices. We're already at $80, which are levels that he threw his toys out the cot in his first presidency. So we think these are relatively high and elevated levels for oil in a Trump presidency. So we see downside risk to oil. Obviously, unless there's further instability in the Middle East or world wars. But if that's the case, we think it's a better way to protect your portfolios via gold as opposed to oil, just given the range of probabilities. I think moving further forward to South Africa and the key variables we see for South African growth in 2025. I think just front running the question in terms of the GNU and GNU stability, we think the GNU will remain relatively stable in 2025, and GNU stability in 2026 will largely be dependent on how successful South Africa is in 25 and how South Africa grows in 2025. We think it's extremely important that we have a good year, particularly on the growth side, to justify the GNU going forward, just given the parties involved. So the four things we're looking out for in the South African market, the first one's on the reform agenda, and I think we've spoken about this for the last 12 to 18 months. We've seen the improvements in Eskom. We think it's extremely unlikely we go past stage 2 at all this year. Hopefully we don't get load shedding, but we think even if you get sporadic stage 1 and 2, it's a significant improvement. And then on Transnet, we stick with our view that trough volumes are in 2023. You get a slight improvement, and we saw a slight improvement in 24. And then once you get private sector operators starting to operate from April this year, we think you could get a relatively significant increase in rail volumes and in Transnet volumes. So in terms of the reform agenda, we're very confident that it will continue on a good path, and we think it's very likely to help GDP growth in South Africa this year. The next topic is on global macro. The first one's obviously on tariff news, and I do think there will come a point in time this year where South Africa will get threatened with tariffs. It's going to be very important on how our politicians navigate that. So that's something that's obviously a big focus for us. And then, the other point on global macro, which is outside of our control is on commodity prices, particularly on PGMs, which I've spoken to. We're relatively negative on that. And then iron ore and coal, which is largely going to be China dependent and obviously offset with our biggest import, which is oil. In terms of global macro, that's still relatively uncertain at this point. And I think we'll probably get a bit more color as the year goes on. The next one's on capital flows, another extremely important point that's, maybe a little less well known. Foreign investor inflows, we think, will likely, if South African growth picks up, impact South African markets in the second half of the year. We think after Ramaphoria, foreign investors are taking a bit of a wait and see approach, and they're waiting to actually see some of the growth coming through before they invest in the South African market. The other one is on domestic outflows. You can also characterize this as the narrative within South Africa, whether it's Reg 28 changes, wealth tax, unit trust proposals. There was another proposal from the Department of Trade and Industry over the weekend. These are all capital flow negative and lead to domestic outflows. And it's just not really what South Africa needs at this point. We need capital in the country. We need companies listing. We need companies raising equity, and we need companies investing in South Africa. So this is still uncertain. I think we get a lot more clarity on capital flows, particularly at the budget. I think a number of these things will be or won't be announced at the budget. So we think this is an extremely important budget, or one of the most important budgets for South Africa in recent years. Less so on what the deficit is and more about policy coming out of National Treasury in particular. And then the fourth one's just on SARB policy. I think over the last 6 months, we did jump up and down a little bit about how the SARB had capacity to cut further. We think they should have cut at least another 50 basis points. We think they had cover from the Fed in particular, cutting rates 1%. The fact that inflation was below our target and we only cut 50 basis points, I think, is very unfortunate. There's obviously a meeting at the end of this month. We think it's extremely important for the South African growth narrative that we do get another cut in January. I think the market will become extremely concerned that we don't get another cut in 2025 if we don't cut next week. So it's another, one of the bigger and more important meetings that we've had in terms of the SARB in recent years. We think it's almost an absolute necessity that we cut another 25 basis points in January, and that leaves the door open for further rate cuts throughout the year. We think a hold next week will likely lead the market to think that we're done with the cutting cycle, and we think that just doesn't help the growth narrative of South Africa. So I think just in terms of this slide, sorry, I think something's just popped up. Maybe just click. Oh, there we go. I think just in terms of the slide for us, what we think we need to have a relatively decent year is 2 out of 4, and to have a good year, we need to have 3 out of 4. So that's what we're looking at, and we think within the next quarter, we'll be able to frame a relatively strong view, whatever happens at the SARB meeting, and then obviously what happens at the budget in terms of how likely we are to have this decent year. I think just shifting to the next slide, and again, our view hasn't changed significantly on China over the course of the last year, and I think 2024 reinforced our view quite significantly. China's gone on this path for its property sector to decline, and ultimately they have to accept a lower GDP growth rate unless they pull the levers of these three things. I think you've seen them pull 2 of these levers relatively significantly in the course of 2024 in terms of increasing exports and promoting new technologies and sectors, particularly on the automotive side and the renewable side. The one you've started to hear mutterings on has been on the domestic consumption side. We think it's the only real lever they have left, particularly with Trump putting pressure on the export side. We think they have to stimulate domestic consumption. It's easier said than done, but we think this is a multi-year theme within China, and the big beneficiary of this would be a company like Tencent. Saving rates are obviously extremely high in China. There's structural reasons for that. We don't for a second think they're going to become a consumption-driven economy like the US, but we do think there's significant capacity over the next couple of years to pivot some of their economy to be more consumption-driven. Then just in terms of global rates, This is just the US, Europe, and the UK. The x-axis there is just number of months for 2025, which 12 being December. And this is ultimately what the market's currently pricing in for rate cuts in 2025. You can see the US is pricing in around 40 basis points of cuts. The UK is pricing around 60 basis points of cuts. And then Europe is closer to 1% of cuts this year. We think there's scope in the US for rates to be cut a little bit further. We think everyone's extremely positive on the US economy, and any sort of growth scare we think is likely to be met by a more dovish Fed. Also, what you saw in the first Trump presidency is any sort of sign of growth slowing down. There was a lot of pressure put on the Fed by the Trump administration to cut rates further. So out of all the countries, we actually think there's the most scope currently from what the market's pricing in for there to be a little bit more rate cuts in the US. And that's obviously should weaken the dollar throughout the year, which should be positive for commodities and emerging markets and, gold in particular. So I think those are the main themes that are framing the way we're thinking and some of our high conviction ideas. We'll just run quickly through performance and how we've done over the last while, and then just talk around how we've been positioned or how we are positioned going into 2025. It's obviously been a really good run for the fund over the last couple of years. We're very proud of the performance we've been able to achieve, not just the returns we've been able to give investors, but also the lower risk and standard deviation to our peers in the markets. Whether you look at information ratios or Sharpe ratios, or simply how many months we've outperformed over the last 5 years, we've been able to outperform 75% of the time over the last 5 years, and it just speaks to the consistency of returns that we've been able to achieve. And just in terms of performance, particularly over the last 12 months, it was a very good 2024 for the fund. The outperformance was largely driven by three factors. The first was on a sector basis, going more overweight South Africa going into the election. We thought that South Africa wouldn't, on a balance of probabilities, you would get a relatively decent outcome. And we thought valuations got to very silly levels. So from a sector basis, we went overweight SA Inc. going into the election. Another reason we did well was we were overweight Naspers Prosus versus diversified miners and PGMs, just looking for that change in consumption trend within the Chinese market, which did well. And then the third point was just on stock selection. Even though we did go overweight, and if you went overweight SA Inc. with pretty much any stock, you would have been able to outperform. But we went overweight the right stocks, particularly Mr. Price and Pepkor, and some of the banking stocks, which gave us a lot more gearing to a positive outcome. We think there's a number of stocks within the South African market that are considered SA Inc. stocks that have diversified over the last number of years that don't actually have as much gearing to the South African economy as the market thinks. And those were either the stocks we didn't hold or sold out very quickly after the election. I think a good example is a company like Afrimat, which is considered a South African construction stock, but actually 60 to 70% of its earnings over the last few years has been iron ore. The iron ore price has been going down and the rand's been getting stronger. That's actually very negative for Afrimat. And we think this theme of having pure South African companies versus some of these companies that have diversified into commodities or offshore, you'll see that quite significantly coming through in this next result season. I think Raubex is another example to a lesser extent, where 30% of its earnings come from chrome mining. Chrome's down 40% over the last few months. So it's going to be very tough for those companies to offset those commodity earnings. And there's a number of companies, whether it's in the retail sector, food producers, that have diversified quite significantly offshore and just don't have as much gearing to a positive South African economy as they previously did. Then, over the last 3 to 5 years, I think we went through a process, we did go through a process change around 6 years ago. Performance has been extremely positive since then. Over the last 5 years, we've had consistent alpha generation over time. This isn't a fund that's going to go up 20% relative to its benchmark in 1 year, but we also relatively short. It's not a fund that will do minus 10% the year after that. We're looking for consistent alpha generation over time, and since the process change, we've been able to produce that at a low volatility relative to the market. Then just in terms of how we've positioned going into 2025, I think first on SA Inc., we've pulled back our SA Inc. exposure a little bit over the second half of the year. We did that in two stages. The first was relatively soon after the election, where we sold out of a number of companies, as I mentioned, like your Afrimats and Ralbexes, that actually don't have as much gearing to the South African economy as they previously did. And then later on in the year, in Q4, we sold down a little bit, just given the run that they had. And also, when we came out of the election, the last thing we thought going into 2025 that our biggest concern would be around the finance cluster and how the finance cluster is acting, whether it's Treasury or SARB in terms of 2025 growth. We've seen a number of positive things coming out of the GNU, whether it's the Electricity Ministry, which actually started obviously before the GNU, but then the Transport Ministry in terms of Transnet reforms. You've seen positive developments in terms of Home Affairs, but you haven't seen as much pro-growth narrative coming out of the finance cluster, whether it's lowering the inflation target, talking about wealth taxes or unit trust proposals. And a number of these things aren't pro-growth measures. So we'd like to see a little bit of a more pro-growth narrative coming out of that finance cluster over the next couple months to get us more confident that we are on this 2% plus GDP growth track. Then just in terms of South African Inc. positioning, we have tilted the portfolio a little bit more to value orientated growth. We like to call it liquid value in the market. We haven't gone down the liquidity curve. And the reason for this is relatively simple. We think over the last 10 years, you've had a market dynamic where to gain market share or to do well as a company, you've had to take it from another company, being in this no growth environment. So you've seen this massive dispersion in company performance between your high quality companies and your companies that have been taken, that have market share taken away from them. We think in a 2% plus GDP growth environment, we think everyone benefits, and we don't think there's a need to have such a dispersion in valuations between your slightly higher quality companies and your slightly lower quality companies. So we see significant scope for a re-rating further in those slightly lower quality companies if you do get consistent GDP growth coming back into the market. It's not to say that you won't earn a good return in companies like Capitec, Shoprite, Clicks, your higher quality companies in a positive South Africa environment. It's just you won't earn as a significant return, we don't think. Very similar to the PGM sector. If you bullish PGMs, you buy Impala and Sibanye, you don't buy Amplats. So we think there's a little bit of crowding into that higher quality space. And if this GDP growth story does come through in South Africa, we think you get a higher return in some of these lower, slightly lower quality, more value orientated names. So that's why we're in companies like Absa, like Remgro, and we've even been buying companies like MTN for the first time in a while. I don't want to go into too much detail on specifics, but we aren't taking massive sector bets at the moment. We think there'll be a time and place to take, significant overweights or underweights in various sectors. We do just think the start of the year is a little bit uncertain, and we think it's more of a stock pickers market to start the year. And I know I'll get the question on the webinar about why you underweight Capitec. So I can maybe just touch on that. We do think Capitec's obviously done extremely well. It has re-rated. We do think some of the earnings regions that it's gone into now are slightly lower quality in nature. The significant step up in something like value-added services is 90% of that, or majority of that, is actually just voucher selling into online gambling. Very similar to Pepkor, who calls the division fintech, but a large portion of the fintech division is actually selling vouchers that go into online gambling. I think everyone's seen the news on how much online gambling has grown. We think that industry, in particular the online segment, is extremely susceptible to A, regulation, and B, increased taxes. So we don't think those are high quality earning streams. Maybe like when Capitec went into things like life insurance, which is a lot more long dated. We don't think the growth in online gambling at these sort of rates is sustainable going forward. So that's just one of our concerns there. Then just in terms of some of the other positions, it's a lot of them, as you can see, are just relative decisions, whether it's Absa over Netbank and Standard, Anglo Gold over Goldfields. And then on a more sector basis, this is probably the least underweight, something like telcos we've been for quite some time. So this is my last slide, and that's currently where we positioned. I don't want to ramble on about every single position we have or stock and sector. Maybe better if we just open it up for Q&A and I can answer specific questions that the audience may have.
Matthew, very insightful indeed. Thank you so much for that. I maybe want to start with a bit more of a global macro question. I mean, a lot of the naysayers got it wrong the past 2 years, being afraid of inflation and talks of global recession beginning of last year. And markets proved them very wrong. I mean, markets performed extremely well, SA markets, global markets, right across the board. But again, those kind of talks of recession is popping up, especially if you listen to analyst companies like the bank credit analyst, a lot more bearish this year than what they were in 2024. And a lot of that information is based on a weakening US consumer, inflation maybe not as under control as people would have wished for, rising US bond yields. And I know we're focusing here on SA equity, but I mean, we've seen it if anything happens in the US, the rest of the world catches a cold as well. Your views on that? I mean, is the world healthy enough to see a lot more growth in 2025, or is higher bond yields maybe restricted or restricting potential earnings growth?
Yeah, so it's an interesting question, and there's a few parts to it. I mean, our view is that US growth could actually end up being a little bit slower than the market currently expects. But going further than that, it's, what is the actual response to that slowing growth? And I think, similar to what you saw in Trump's first presidency, he's ultimately pinned his success of his presidency on how high the S&P goes. So you could very easily still have a situation where US growth actually slows a little bit more than the market expects, and you still get positive returns coming out of US equities in particular. So it's just that kind of dichotomy with what we're dealing with at the moment. We do think it's very likely, as I mentioned in the presentation, that if you do see US growth starting to slow, you are going to get quite a significant response from the Fed, and particularly from Trump on the fiscal side, trying to defend that. I think that's kind of what you've seen over the last couple of years in terms of the US market. And it's very hard to see an extremely hard landing, given that that would be seen as a failure for Trump. So, in terms of the rest of the world, it's a lot trickier. We do think China is doing the right things, although it's doing it a little bit slowly. Europe and the UK are obviously in an extremely tough place. But I do think a lot of negativity in terms of tariffs has been priced into global markets. And I think just from the first couple of days of Trump's presidency, it very much seems like he's using tariffs to either strong arm countries or use them as a negotiating tactic. It doesn't look like he wants to put blanket 20% tariffs across the world and then just leave them there. It's not a revenue raising exercise for him. It's more of a negotiating tactic. So even your Europes and the UKs, we think they should be able to muddle along, just given the amount of rate cuts they're currently priced in. So, we do think there's a chance that global growth does actually slow, particularly US growth, but that doesn't mean that it's going to be negative for equity markets, particularly in the US.
Interesting indeed. I mean, there's a lot of commentary out there on Trump, in what he says and what he actually does, strong-arming countries and people. He's a deal maker. We'll see how much deals he actually makes in 2025. Very, very interesting. Maybe Israel the first of what he did. Let's just look at SA versus global. I mean, if we look at valuations, the S&P 500 relative to the JSE or the Capswix Even though we had very good returns, strong returns in the SA market in 2024, our market still appears to be cheap relative to the US market. A lot of investors asking, with the US markets getting more expensive, yes, there's a lot of incentives behind AI at the moment. And if you look at who Trump is surrounding himself with and backing AI in tech and developing the tech in the US. But where do you go from here? I mean, would you, yes, your SA equity fund, no global, but you run other mandates as well with global. How do you weigh it out, that whole debate in terms of, do I start to underweight the stuff that's expensive and did well, like the US or the mega caps, which can pretty much still rally, the party can go on with Trump behind it? Or do I lean stronger into an SA market that's still very attractive?
Yeah, so I think there's two things, and it's almost become US versus the rest of the world in terms of in terms of the decision on US equities. I think in terms of the rest of the world, I think South Africa is looking extremely attractive, particularly against the rest of emerging markets. I mean, you've turned. I mean, there's a number of basket case emerging markets at the moment. Obviously China's in quite a bit of trouble. Brazil looks like a disaster, and very similar to Mexico. So on a relative basis, in terms of emerging markets, South Africa, we think looks extremely good. And if you can get to this 2% GDP growth target, that's extremely positive. I think on the US side, it's very hard to be very negative on US companies, just given that Trump is going to dictate his entire success on the S&P. So I don't think it's an either or in terms of, whether you invest in South Africa or whether you invest offshore. I still think there's scope for the US market to continue to do well, you know, just from the fact that Trump's there and he's going to try and hold up the S&P by any means necessary. But in terms of South Africa and allocation to South Africa, we think there's very decent scope for beta to come into the South African market if we can hit this 2% GDP growth forecast for the year, or target for the year. We think we're only likely to get relative certainty on South Africa's GDP growth growth target towards the second half of this year. But it sets up a very good, good couple of years if we are able to do that for South Africa. So I don't think it's an either or. I think it's very hard to bet against, the most
Yeah.
powerful man in the world, who's trying to hold up equity markets. But it's not to say South Africa doesn't, have relatively good prospects here as well.
And potentially forming a new oligarchy in the US, but we'll see how that plays
Yeah.
out. Biden warned, but let's see. Um, SA growth. I mean, there's a lot of talk about that. You mentioned that in a couple of slides just now in your answer as well. People wondering where is our growth going to come from. One of those factors are obviously capital flows. We haven't seen it back into our equity markets yet. They're still buying our bond markets, which is very positive. We've seen strong growth from our bond market last year. But let's get to SARB potentially cutting rates. You mentioned that SARB actually needs to cut rates. But by how much does SARB actually need to cut rates to actually support the consumer? One of the questions from the audience. And on that as well, will SARB cut or decouple from the Fed? Is the SARB not scared that the Rand can potentially lose value if they decouple from the Fed and start cutting more?
Well, I mean, that's our entire argument on why we think the SARB made a policy mistake in the fourth quarter of last year. When you had the Federal Reserve cutting 1%, it's significantly easier to cut when the Federal Reserve is cutting. Now you have to cut at the end of this month, and I say you have to cut at the end of this month in the face of the Fed, starting to slow down. I think the SARB stuck in this mentality that they single-handedly protect the value of the rand, and I think that's just not what happens. And I think we're holding real rates at 4-5%, whatever it is. And the moment Trump came in, you saw a devaluing of the rand. I think when you look at 21, 22, you saw the rand go stronger, even though we're running negative real rates. And very similar post GNU, you saw the rand strengthen off the back of increased growth expectations. So we think all three of those scenarios, a lot of the rand movement is being priced off future growth expectations. So we still think that the SARB can cut rates as long as the market still thinks that South Africa will grow. If the market stops thinking South Africa will grow, there's nothing that the SARB can do in terms of the rates that's going to help the South African rand. That I'm certain of. So it's tougher for them to cut now. But we still think they have to cut, and we don't think the rand's going to blow out if they cut 25 basis points here. How it goes further from the 25 basis point cut now, we'll see what happens, and that will obviously depend on what happens in the US. But if tariffs aren't too bad, dollar rolls over a bit, you get a bit of ZAR strength. It will give the SARB cover to cut further as the year goes on. I mean, we'd like to see at least 2 or 3 more rate cuts this year from this point. To be honest, they should have just front loaded it at the start, and we should already be 1.5% lower. I don't think our currency was going to blow out running 3% real, to be completely honest. But yeah, let's see what happens next week. I do think, just reiterating the point that if we don't cut next week, I think the market does get very concerned that we don't get another cut for the rest of the year, and that would send a very negative signal, I think.
Definitely going to send this according to the Reserve Bank afterwards. Staying on rate cuts, question from the audience, a bit more sector specific. What is your take on financials given potential rate cuts?
So I mean, if you look at the banks and who benefits the most or who benefits the most from rates going up, it's Nedbank and Standard Bank. ABSA actually hedge interest rates, so when it's coming down, they have the least gearing to that. So that's another reason why we prefer ABSA over, say, Standard Bank and Nedbank, is as rates go down, you see a bigger impact on Standard Bank and Nedbank than you will on ABSA. Obviously, there's a credit loss element to it, but just simplistically, when interest rates are going down, you should have less of an impact on ABSA than you do on Nedbank and Standard Bank. First Rand also has less of an impact. So, I mean, the least impact, it goes ABSA, First Rand, Standard Bank, and Nedbank, who has the most gearing to interest rates and negative gearing on the way down.
That does answer another question from the audience on Standard Bank. Why are you underweight on Standard Bank? So we got that. Maybe just quickly on the drag on the SA budget and our deficit. SOEs obviously playing a big role in that. All of them more or less bankrupt. There was silly talk beginning of the year that they're thinking of opening a stock exchange in Soweto, which I got the giggles when I heard that. But more interesting is they are thinking of listing some of the SOEs. Now, whether that's fiction or not, or whether it's going to happen or not, but what I took from that is, doesn't this show a bit more willingness from the government to actually start privatizing SOEs? Your views on that?
I think it does show willingness. There's 2 things: either there is willingness to privatize these SOEs, but in its current form, it's going to be extremely hard to see what sort of private capital actually will invest in these SOEs, particularly on the Eskom and Transnet side in their current form, maybe Transnet to a lesser extent. I think if you list these SOEs, it's more than likely the only real private capital that will be looking at it to invest will be the PRC at this stage. So, I think it's early days on that. I think we need to see more reforms coming through. And hopefully it is a genuine willingness to reform some of these SOEs and not just a backdoor way of, getting the PRC to throw capital or equity capital at these companies.
Devil's always in the details, isn't it? Maybe just on rate cuts, back on rate cuts, you showed that the EU has got a bit more room to cut. They're a bit further behind. Would that influence your regional allocation away from the US, looking more towards the EU, or are you just avoiding the EU?
So I think, those rate cuts were what was currently priced into the curve. So when we look at what's currently priced in, we think, that's what the market is currently pricing into equity markets. And then we make a decision from that on, do we think there's going to be more or less rate cuts from that point? So we think the market's, pricing in 1% for the Eurozone. That's relatively what's priced into the equity markets. At this point, we don't have a strong view that, the Eurozone will cut less or more than that 1%. So in terms of equity markets in the Eurozone, that particular curve wouldn't make us move capital from one side to the other unless we thought, we had a differing view to the market. Whereas we have a differing view in the US where we think rate cuts could actually come down further. What would obviously be positive and what we are invested in on the Eurozone side is a couple of the property REITs within South Africa that do have exposure to the Eurozone. They would obviously benefit quite significantly from those rate cuts coming through with another 1% of rate cuts. So we do have exposure to some of the property REITs in the Eurozone, whether it's Nepi, Rockcastle, or Mass Property. So we do play in the Eurozone, but I don't think we'd be big movers into the Eurozone economy now. And you also have to think that the Eurozone also has some similar drivers to the South African economy. Obviously, it would benefit quite significantly if the dollar came off and things like that, and there were less tariffs. So we'd prefer to rather play in the South African market to play some of those, weaker dollar themes as opposed to going into the Eurozone.
361's never been shy to include property in your equity portfolio. It's very specific counters that you hold from time to time. Last year, you've had some exposure to SA property as well. Going into 2025, SA property, particular counters that you're interested in, that you're still holding or want to get more of?
I think the hardest thing for us on the property sector side, and we looked at it pre-election, was, similar to the issues we had with some of the other companies, was we wanted pure South African property exposure. It's not that easy to come by. A lot of the companies have diversified offshore, and they're big companies now with European exposure, UK exposure, Australian exposure. One of the counters we bought up quite significantly in the funds, and it is one of the smaller names, is Sphere, which is a Western Cape focused REIT, and they're going to stay in the Western Cape, and we were able to buy that share at a 10% DIPS yield and a 9% dividend yield. I don't know if anyone wants to go and try and buy property in the Western Cape at those sort of yields. You just don't find it. So we think there are attractive opportunities within the REIT sector. It's just about A, getting liquidity, and B, getting the property exposure that you actually want. Would we like more exposure to a company like Sphere? Sure. It's just a question of liquidity and actually being able to get the stock in some of those specific counters, as opposed to some of the other property names that are very diversified.
Very interesting indeed. I want to dive a little bit more into your actual fund, and a question from the audience as well. Speaking to things like Tencent, you've made mention of Tencent around about the 7th of Jan, saw a massive drop in Tencent price with the inclusion in the Pentagon's list. Your view on Tencent, is that your sentiment and just talk, or is it just fears, or is there still good growth and earnings to come?
So we are very constructive Tencent from a bottom-up perspective. If you looked at how we positioned over the course of 2024, we actually cut on Naspers exposure twice during the year. The first one was pre-election to fund some of our SA Inc. overweight, and the second time was towards the end of last year, in November, December. And there was a few reasons for that. One was just around the concern around tariffs. There was actually a drop in the index weight in December. And then there's also something technical that Tencent's buyback before its Q4 results stops for a period of 2 months, which is obviously, usually doesn't do well during the period where the Tencent buyback doesn't happen, but Naspers process is still selling. In terms of the Department of Defense, we've done quite a bit of work on it, and the Department of Defense list in isolation isn't a problem for Tencent. The real risk is if they get added to the OFAC list. And unfortunately, 75% of companies that are on the Department of Defense list get added to the OFAC list. And the OFAC list is the list that then US investors over 12 months have to disinvest from Tencent. What will likely happen if they do get added to the OFAC list is similar to the cell phone company that was added to the OFAC list, as there would be litigation. We think there's a relatively high probability that Tencent won't end up on the OFAC list post the litigation. We do think they have a relatively strong argument, and it does seem like they already, positioning themselves for the potential of that OFAC list. The unfortunate thing is you can't litigate being on the OFAC list before you're on the OFAC list. So you could get one more negative surprise there in terms of getting added to that OFAC list, but we do think there'll be litigation. And we've done the analysis on, how much certain companies have dropped from going on the Department of Defense to OFAC to being, excluded from the US markets, and it's around 15 to 20%. I think you saw a drop of around 11%. So we think most of the move has been done there. If we do get added, or if Tencent does get added to the OFAC list, we'll probably be buyers of the stock quite aggressively. And we do think there's a number of decent reasons post, one or two tariff news that there will be attractive opportunities to buy Tencent this year. I think the one thing, and importantly, and why we also brought down our weight towards the end of last year, is we do think you're going to have at least 2 or 3 times this year where Tencent goes down 10% in one day. And we just want a little bit of capacity to buy there. As I said, from a bottom-up fundamental perspective, we think it's one of the few companies in the world that's at a mid-teens multiple that will grow at 15 to 20% with a thematic, like a massive economy shifting to consumption. It's something that will always be a core holding. It's just about us, kind of trading around news and trading around the edges.
Got you, Matthew. I'm going to stay with fund-specific questions from the audience, and very specific, asking how many stocks do you typically hold in your portfolio, and relative, if you look at your outperformance over the past 5 years, it seems to have improved remarkably from mid-2019. What has accounted for this, and was it a change in process?
Yeah, so we changed our process
Couple
around
of questions.
Yeah, so we changed our process around. Let me just start. I think we hold around 60 to 80 stocks at any one time. It's not something we monitor specifically, and it's not something that we target. Maybe like some other funds of a specific target, but usually around 60 to 80. We did go through a process change around 6 years ago to become more benchmark cognizant. And we think that's led to the consistent alpha generation that we've been able to produce. We don't have set bands in terms of specific under and overweights. We don't think it's optimal to have set bands. The reason for that is because companies and sectors beta relative to the market changes over time as capital structure changes, as their capital structures change over time, particularly in things like the gold sector. There's been a number of, and it's become a bigger thing over the last 6 years, and I'm glad we did it 6 years ago, just in terms of how the benchmark has changed over time, particularly in things like the gold sector. I mean, at points, the gold sector was 3%, it's now almost 8% of the index. Now this process gets reweighted every 3 months. I think it's very important to understand where the benchmark is and where your position sizing is relative to those benchmarks. So it's been a big focus for us. Looking at beta relative to the market of certain stocks, cross correlations between sectors. It's been a big focus and a more quantitative process in terms of building a portfolio that's led, we think, to the consistent alpha generation over time. I think if you look over the last 5 or 6 years, there's been a number of different themes in terms of the market. I think 2020, 2021, we made money we made quite a bit of money out of commodities. 22, 23, we think was more stock selection, and 24 was obviously quite a big sector bet on SA Inc. So we think we've been able to rotate the portfolio relatively well and been able to capture a number of these themes within the market. But we think it's just the way that we changed our portfolio construction that's led to the more consistent returns over time.
And I mean, you're a prime example of why active management can work for some fund managers. 361, a very good example of that. Again, looking at your fund and specifics in the fund, you touched on your views on PGMs, very negative. But what about gold? Gold's done significantly well. Do you have specific or explicit gold exposure going into 2025? And what about the gold miners?
Yeah, so we do have an overweight, and we have had an overweight for quite some time in the gold sector. We still continue to think that gold relative to PGMs is the right way to play things, and then obviously gold over oil to protect yourself against geopolitical risks, we think gives you a better risk return profile. In terms of the gold miners, we've been overweight Anglo Gold relative to the other miners for quite some time. to be honest, this is the first result season we're going into where we are actually constructive and think that all three of the major gold miners will produce decent results and have a relatively good 2025. I think we've been negative on Gold Fields for quite some time, just given its project Solaris Norte. We think the main issues with that are starting to come to an end, and they should have a better 2025. So even though we're underweight, we aren't as negative on Gold Fields as maybe we have been for some years. And very similar with Harmony. We think Harmony will post extremely strong results. As you know, we'll be probably one of the biggest taxpayers in South Africa from a commodity perspective, just given how well they've been doing. Our concern slightly around Harmony is just whether they do decide to turn to M&A at some point this year. We've seen Anglo Gold do M&A, we've seen Gold Fields do M&A. Usually they go one after another, so Harmony's probably next in line for that. But yeah, I mean, across the gold sector, it's very hard, over the next 6 to 12 months from an equity perspective. We think all the gold miners have relatively good stories. Usually when all the gold miners have good stories, I get a little bit worried about the gold price. But just from a gold versus PGMs versus oil perspective, we think gold's still the right way to play those relatives.
Matthew, this wouldn't be an investment discussion if we didn't talk about currency. Everybody talking about that. The dollar obviously remaining very strong. Huge amounts of assets still flogging to the dollar. We know Trump wants a weaker dollar, but what he wants is not necessarily what he's going to get. Your views on the dollar, the rand going forward?
So, I mean, the currency markets are very interesting at the moment. I mean, outside of the dollar, you've seen huge rand strength over the last year, particularly against things like the Aussie dollar, the euro, the pound. And then the currencies, even in Africa, that we spoke about, that we needed to see these massive devaluations like the Naira and the Egyptian pound are going to start lapping those bases and actually be stronger year on year. You've seen the Brazilian real and Mexican peso blowing out significantly. So we think currency markets are very interesting. I mean, simplistically, what we think on the rand is that around 19 is kind of the top of the range. The reason why we think the rand at 19 is top of the range is just in terms of flows and in terms of Reg 28. When the rand goes to 19, most balance funds are at 45% or higher. So they're almost forced to bring money back. So you get those sort of capital inflows. And then similarly at the bottom of the range, we don't think the rand can on these commodities strengthen much past 17 because it bankrupts pretty much our entire mining sector. So when we got into the low 17s, we think that's kind of the pressure point. And that 17 to 19 range is kind of where we're comfortable in on the rand. People calling for 15s to 14s. I mean, I'm a commodity analyst. If I put that into my models, I mean, we're losing hundreds of thousands of jobs. So I don't know if we on these commodity prices. I mean, maybe if you get a bounce in commodity prices and big China stimulus, then maybe we can go to 15s and 14s. But I think the days of below 17 in this sort of commodity price environment, I think are unfortunately gone. Just in terms of the dollar as well.
Yeah, sorry.
Yeah, and then maybe just in terms of the dollar, I mean, we are of the view that Trump does need a weaker dollar. What he gets is another story, but I think you've already seen him balancing and using tariffs as a negotiating tactic. We don't think the dollar can go significantly higher from here sustainably for Trump to deliver on his mandate. So we are in the slightly weaker dollar camp here.
Thank you for that. And last question, you did touch on China, but I mean, China was a big part when it comes to commodities. We've seen stimulus from China in 2024. It ramped up towards the end of the year. We did see a bit of recovery in direct China stocks as well. But the stimulus in China, isn't it more about their own recovery and less of new construction, new demand on resources? Will China ever again soon have a real impact on resource prices?
So I think China still has the biggest impact on resource prices. In terms of whether they stimulate the property sector again and get particularly the bulk commodity price, I mean, going higher. That remains to be seen. But China's been very good over the last few years, and that's why our big focus is on the supply side of commodities. They've almost flooded certain commodity markets with supply, whether it's been nickel, lithium, cobalt. And the reason they do that is because they're the biggest user of these commodities, and they're incentivized to have lower commodity prices. So that's why when we look at the supply side of commodities and we see a market, that's into the cost curve, if it's into the cost curve, but that additional production that should come out is Chinese production, we think that goes on for significantly longer. I mean, I think you've seen it in the chemicals market, you're seeing it in the nickel market, lithium, cobalt. I mean, the one positive on the PGM side is it's one of the few commodity markets on the supply side that isn't dominated by China. It's basically just four South African companies and Russia. So, I always say it is the worst run oligopoly in the world. But at some point, you can actually match supply to demand because you have profit-seeking entities who are on the supply side, or at least you hope. Whereas a lot of Chinese production and a number of these other commodities, we don't think are profit-seeking. Very similar to what they want to do in the iron ore market with bringing on Samandu, is ultimately just to depress prices to make it cheaper for overall industry. So we still think, particularly on the supply side, that China will definitely have the biggest impact, and on the demand side, it still is a massive driver. The commodities that we always are the most interested in are the ones where China has the least impact on the supply side. Things like copper, met coal, it's having a bigger impact now on thermal coal, but doesn't have a perfect impact, and something like iron ore. Those are the interesting commodities for us because China isn't trying to depress the prices.
Very interesting indeed. Very, very last question, just very quickly, in terms of potential risks and headwinds from a 361 perspective. What are some of your concerns and some of those factors that you're really watching closely?
So I think the biggest factor that we're watching, and we do think you will get a scare at some point, is just in terms of the South African market on tariffs and how our politicians react to that. I think Trump will use it as a negotiating tactic at some point. There's obviously things we've done in the recent past that Trump and the Trump administration likely won't be happy with, just given our affiliation more to the east than the west. Our association to BRICS, although thankfully he thinks the S in BRICS is Spain. But eventually he's going to work out that South Africa, and I do think we will have tariff risk. It's going to be very important for our politicians to negotiate, and I do think we have a relatively decent negotiating ability. We are the biggest economy in Africa. We do have a very strategic location, being at the southern tip of Africa. I don't think the US wants to cut us off entirely. So I think it's going to be important that we negotiate well in that we don't dig in our heels and try and take a more aggressive approach to the Trump administration. So I think that's probably the biggest risk just in terms of South Africa, is just how we react to tariff news. And I do think tariff news will come through at some point this year.
You think Elon will whisper some words of comfort in Trump's ear and say, "Go easy, that's my country of origin"?
I think that's very unlikely. I think maybe the opposite. I think he wants Starlink, yeah.
Exactly. Matthew, you've covered a massive amount of ground. Thank you so much for joining us this morning. I think we've covered most of the questions coming in from the audience as well. There's one or two open questions. Some of them are unfortunately anonymous, but we'll get some of those questions through to you. We can maybe answer that via email as well. But again, thank you for standing clients extremely well for the past couple of years. 361 is really a good example of active management working hard for our clients. Thank you so much to you and your team. And we're looking forward to seeing a lot more of you and everybody at 361 in 2025. Thank you so much.
Perfect. Thanks very much, Eugene, and thanks very much to everyone who joined the call, and all the best for the year. Says everyone.
Fantastic. Just a quick reminder to our audience out there. Next week, Wednesday, the 29th of Jan, we're starting with our offshore investment managers webinars, a series of 3 running for the 29th of Jan, 5th of Feb, and the 12th of Feb. It should be very interesting as well, getting all those global views And if you want to send some questions in ahead of time, you're more than welcome. Contact one of your BCI team or representatives, and you can send it through to us, and we can try to prepare some of the speakers on that as well. Thank you all for joining us this morning. Have a terrific 2025, and let's see how things play out. All the best. I'll see you next week, Wednesday, for the offshore webinar. Thank you.